Okay, now it's time to speak to David Talbot. He is the head of equity research at Red Cloud Securities. He's a highly experienced mining equities analyst. He's speaking to us from Toronto, Canada today. He originally worked as a field geologist and since then has been a leading equities analyst in the mining sector for over 20 years. David's going to put Red Cloud Securities into context for us. He's going to talk us through uranium and he's going to talk us through lithium. Really, it is slightly useless, slightly pointless me introducing David when he's here himself. David Talbot, why don't you introduce yourself?
Thank you for that, Donald. Appreciate it, and thank you for the invite today. My name is David Talbot. I'm Managing Director, Head of Research at Red Cloud Securities. I am a geologist by trade. I worked for 10 years in the global exploration industry. I worked for Placer Dome, Franco-Nevada, and Newmont. So really cut my teeth on the greenstone belts of Ontario, the Gold Camps, Timmins, Kirkland Lake, Detour, Musselwhite, Hemlo. Following the Franco-Nevada Newmont merger, I did make the jump to capital markets. So I joined Dundee Capital Markets in 2003, which later morphed into 8 Capital. I think I was about 2016. And, I covered the gold stocks at first, but by 2007, I was covering uranium. And by 2009, I was covering the lithium sector and then had a full push into the battery metals sector, followed graphite, cobalt in coming years. So at the beginning of last year, I made the jump over to Red Cloud Securities. That's a Toronto-based brokerage firm that covers mining and only mining. And, as a geologist, I enjoy working with these junior mining and exploration companies. I like evaluating early stage projects. As a brokerage firm, a lot of our clients will play these smaller companies. So the bulk of the companies that we work with are typically sub 250 million market caps. And, we do cover stocks in the 1.5 to 2.5 billion range as well. We just spoke to Sigma. We've got Energy Fuels, NextGen, Seabridge, Lake Resources, for example, that we work with. But, our team approaches analysis of these companies with the technical eye. So, we have 3 geologists and a mining engineer on our team. We don't necessarily get into producers quite as deeply as other firms. We want to help our clients on the technical side. So for those of you that aren't familiar with Red Cloud, we're a little bit different than the traditional brokerage firm, given the 2 sister companies. And this has attracted that wide variety of firms to work with us. First of all, Red Cloud Securities, that's the regulated side of the business. It's the one that I spend most of my time in as being a research analyst. Typical investment banking, sales, research, trading. We have an extensive sales coverage, institutional, retail, cap, etc. But a large part of our business is also market making. We help out about 50 to 60 junior exploration companies there as well. And I believe last year we were top 3 in Canada with number of equity financing deals in the works. And I think kept our research team very busy. I think we wrote on about 140 different stocks last year. The Red Cloud Financial Services side is, I think, where we're differentiated from every other bank or boutique. Now, we can manage investor relations campaigns, but really our expertise here is the market roadshows and conferences and webinars and podcasts, social media accounts. I think we probably do 50 or 60 companies' social media. In-house, we do professional videography, website design, dedicated graphic design. We can do company rebranding. Red Cloud TV works with the CEOs to bring their stories to our clients and the general public as well. We try to be a one-stop shop for junior miners, eliminating the need for them to go out and hire several companies to perform these tasks. And really what this does is it saves everybody time and effort and money and lets the companies put the money into the ground. So, that said, I'm pleased to speak to everybody here today. And thank you again for having us on. You know, you had presentations from 3 excellent companies Red Cloud's been working with here in recent days: Sigma Lithium, E3 Lithium, and Consolidated Uranium. That's 2 lithium companies, 1 uranium companies, and sort of a function of the current market out there. You know, I think while gold companies dominate the TSX Venture and the Canadian capital market scene, and it does make up probably the bulk of our corporate client list as well, we do believe that the lithium sector and the uranium sectors are of utmost importance here, as really this green energy and EV transition we see underway globally keeps moving forward. And you know, you heard about those 3 stories directly from management, so I'm not going to dwell too much on those stories. I'll make some comments, but you know, we did speak to these top picks recently on our own podcasts at Red Cloud. So, and I'll speak to a few other names in the moment, in a couple of moments. But you know, we did handpick Sigma and E3 and Consolidated to speak to. We do think these are emerging companies in their respective sectors, emerging as leaders, should say, in their respective sectors. So, you know, Sigma Lithium, we don't necessarily cover the stock yet. We don't rate the stock, but this developer should be producing lithium spodumene concentrate in Brazil by the end of the year. And after expanding, you know, what should be one of the highest grade, lowest cost lithium mines in the world by 2024, we could see Sigma emerge as probably the 4th largest lithium producer on the planet. And as you heard from Jamie, you know, ESG is very important to this company. You know, they're thought leaders in this aspect, and I do think there's a lot of resource upside there for the company. E3, this is a company that's covered by another analyst in our shop, Kobe Kushner. He has a buy 750 target price on the company. This company is entirely focused on becoming Western Canada's largest supplier of high purity battery grade lithium products. They recently announced that strategic collaboration, as you heard, that agreement with major oil producer Imperial Oil, and they're going to get technical support out of that. They're going to get access to land and investment dollars, but really that's a big stamp of approval. And you know, we expect that news to draw attention not just from the mining industry, but also from oil and gas investors. So that could be new eyeballs that are coming down the pipeline here. So, and then, you know, we also recommend Consolidated Uranium with a buy, and we have a 415 target price on that stock. And you know, that is an investment banking client of our firm. But you know, you heard from Phil how he's advancing 3 mines in the USA towards production. You know, it doesn't look like they're going to need much startup capital, and likely can get back into production in short order once they get the go decision. And you know, they have that exclusive toll milling agreement with Energy Fuels White Mesa Mill, which is the only conventional mill that's active in the US. And that should really help re-rate the company from consolidator to uranium producer. So, you know, one of the key themes in mining and exploration these days is the ongoing EV revolution that's underway, and the elements that are required for that revolution. So, you know, EVs are essentially being built or planned by most of the OEMs in the automotive sector. This is one part sort of emergent technology and one part environmental stewardship. You know, there's about 17 countries that are looking to ban internal combustion engines. That represents about 13% of global car sales. Includes Canada, several US states, you know, several countries in Europe, including UK and Germany, amongst others. And, you know, while China doesn't necessarily have formal banishment date outside of Hainan province, the country is certainly well down the EV path and is certainly a leader. And there's a lot of competition in actually trying to get raw materials, you know, because China's, let's face it, they've got first mover status here. So, you know, some of these countries that are banning ICE vehicles here, they're also some of the key countries that build cars, you know, Canada, US, Germany, UK. So, you know, essentially build it and they will come. And ultimately, we think that as EV penetration increases, manufacturing costs should decline, and that'll mean more product is being sold in these countries where the cars are being built. So what does this mean? Really, this means more lithium-ion batteries. And, you heard the name Benchmark Mineral Intelligence. They're a think tank out of the UK. And, they suggest there were over 150 billion worth of investment last year in battery gigafactories. And that's about 60% growth year over year. And it's about double where we were in January 2020. So this is really driving the high annual compounded growth rates for battery raw materials. And if you look at BMI's numbers, they put those CAGRs at, through 2030 at about 18% annually for lithium, 17% for natural flake graphite, 11% for cobalt, 5% for nickel. So, we previously said at Red Cloud, the raw material costs may impact future demand. So really action needs to be taken now to develop these projects so we don't have to worry about gaps in the midterm supply. A little bit about lithium prices. We don't necessarily believe that a lithium carbonate price of $70,000 a ton is sustainable here, especially with prices being over 10 times the cost of producing LCE. The issue isn't necessarily about marginal cost, typical of most, supply-demand dynamics, but there's a little bit more at play here. I think, investors need to treat lithium as an industrial mineral. It's not like gold or silver or copper or uranium. This means that pricing is related to the quality and attributes of the final product. And, that the other thing is, not all deposits are created equal in any commodity, but for lithium specifically, prices are based on purity, impurities, electrochemical properties, and whether we're talking about end products that are desired, are they producing a concentrate, a carbonate, or hydroxide? So, I think it's more like an iron ore or graphite situation in the lithium sector. Certain impurities certainly make a deposit unsaleable sometimes or at least unusable by the battery industry. It doesn't matter how much supply there is. Secondly, and probably just as important right now, are geopolitical influences. And it's no secret that China has been buying as many lithium projects as it can around the world. Many jurisdictions have now classified lithium as a strategic metal, Canada and the US included. Others have gone so far as to nationalize the industry, such as Mexico, or to make that threat, such as Chile, before it looks like they might have backed down from that threat a couple of weeks ago. But we would expect a larger proportion of protectionism surrounding the commodity on the mining side. And, this is really characterized by security of supply by the end users. Many battery manufacturers and even OEMs are now coming upstream to get involved at the company or deposit level. And, we're seeing a greater push by, at least from a lot of Western companies, Ford, GM, Tesla, get involved at the project level. So, what we're seeing essentially is, more activity in sourcing raw materials in North America and Europe. And I think this will lead to a game of us versus them. So China versus the West. And, as said, 150 million spent on battery manufacturing plants last year, up 60% year over year. We think there's more to come. The competition is going to be fierce. And, this is really probably going to be the main key driver of lithium prices now and in the foreseeable future, regardless of the cost profile in the short term. So, we continue to grow our green energy coverage here at Red Cloud Securities. We now follow about 12 lithium companies, plus a few others that have lithium assets as well. There is another lithium exploration company I'd like to mention today, and I apologize I don't have any slides here, but the company is Patriot Battery Metals Inc. So that's PMET on the CSE, and we don't rate the stock right now, but this is a $230 million Canadian company, and they own the large Corvette project in Quebec. This is a tier 1 jurisdiction, excellent infrastructure, even in the north where they're working. And we believe the Patriot's really on a game-changing hard rock lithium pegmatite trend where it's working. There's potential that this is they've got a high grade and diversified commodity mix, a lot of potential on the project. that includes orogenic gold, VMS, there's ultramafic, nickel, copper, PGE as well. But we do believe that the lithium potential is what's catching investor attention right now. And, some of the early drill results are impressive. And just recently they reported 1.22% Li2O over 152.8 meters last week. That's the best drill hole to date. And, rule of thumb, anything near 1% should help create a good concentrate, assuming the con doesn't have too much mica or iron in it. So, but it's certainly a good place to start. And, the better the concentrate, maybe the cheaper it is to produce. You might not need your flotation circuit. Maybe you can just do dense media separation. So, the company continues to work this project. It's up in, near some of the other large Quebec hard rock deposits, including James Bay, Whabouchi, Rose, Moblins up there as well. So, there are 3 trends on the property. There's that 50-kilometer long lithium trend. They've already confirmed about 25 kilometers of strike, combined strike of lithium pegmatites. There's also a 25-kilometer long gold trend and a 20-kilometer long copper, gold, silver trend. So lots for this company to do. Blair Way, he recently assumed the CEO role. He's aided by BPX Darren Smith. So I think Patriot and Corvette really should remain at the forefront of lithium exploration projects in Canada. Just switching gears here a little bit. Last week, Red Cloud hosted its virtual uranium conference. We had about 23 companies in attendance. We had keynotes with Sprott Physical Uranium Trust. We had Horizons Uranium ETF, a fireside chat with 3 buy-side investors on the institutional side. And the theme to our uranium conference last year was "This time uranium investing is different." Well, this year I think we're in for more of the same. Some of our takeovers really remain the same. ESG investors are taking notice of the sector. Uranium, it's finally getting recognition as a green energy source. And, there's a lot of support coming out of the US for both nuclear and for uranium. Demand for physical uranium has increased considerably, both by investors. We've seen the emergence of Sprott Physical Uranium Trust, and probably for the first time I can recall in 15 years covering the sector, by uranium companies themselves as well. So last calendar year, uranium prices rose from $30 to $40 a pound. So summing it up, I think 2021 was really about physical uranium investment. Now in 22, I believe that yes, physical is a key issue, but we also have a layer of geopolitical risk that we really didn't pay as much attention to prior. And namely, that was some unrest in Kazakhstan earlier in the year, and then the invasion of the Ukraine by Russia. But, bottom line, I still like the potential for uranium fundamentals to drive the sector higher. There's with disinvestment in the uranium sector, there has been lack of exploration, lack of discoveries. New mines will be needed in coming years to replace mine closures, let alone cover the growth in uranium demand. Perhaps current prices will help. We're just shy of $50 a pound right now, but many believe we still need to get higher. So I would say uranium prices are much more volatile this year. We started the year at $40. We went to 63. We went back to 43. We're now bouncing around. I think it's $47 right now. But as such, many of the uranium stocks have been bouncing around as well, and performance has been mixed over the past quarter. And with this volatility, I do see this as a good entry point for several of the stocks. Now you heard from Phil Williams earlier as well, but there's a couple other uranium stocks I'd like to mention. Global Atomic, first of all, we have a buy in a 720 target price on this one, and this is also a Red Cloud banking client. But they've had a couple of notable news items recently. They've received a letter of intent from a banking syndicate to finance its 90% owned Dasa uranium project in the Republic of Niger. This includes previously announced indication from Export Canada Development to fund, I believe it was 70% of its debt or something in that ballpark. And this was likely spurred on by its recent offtake arrangement. They also received an LOI to procure uranium from excuse me, they signed an LOI to provide uranium to a major North American nuclear utility. They need to sign those, but really the offer represents about 2.1 million pounds over 6 years. So, and it appears to have, we were spot market related, have floors and ceilings. So relatively small deal, it represents maybe 7% of DASA production over that time period, but certainly it's a strong stamp of approval and may help support debt financing as well. And we expect an updated resource here, mine plan towards the end of the year, which really should provide significant improvements to phase 1 economics. So, overall, Global remains on track for commercial production by late 2024. And DASA is one of the largest, highest grade uranium development projects outside the Athabasca Basin in the world. It's got almost 150 million pounds, grading 0.4%. Phase 1 plans to produce only cover about 44 million pounds, grading about 0.7%, so nice high grade. This project's already heavily de-risked. Key permits are in place, plus there's an MOU offtake for development ore with Orano. So that's sort of our first uranium pick, Global Atomic. Now, the next company I'd like to mention is Valor Metals, and we have a buy $1.05 Canadian target price on that one. And this is also an investment banking client of Red Cloud. So this is an exploration company with a couple different projects in 2 different commodities. So it's advancing its Pedra Branca PGE project in northern Brazil, and its Anglach uranium project in Nunavut Territory, Canada. Now, Pedra Branca hosts about 2.2 million ounces of PGEs. That's a palladium first, then platinum plus gold, and it grades at about 1.08 grams per ton. Resources have grown very quickly here. Both ongoing soil and auger drilling continue. They continue to find new zones of mineralization. They think they're going to spin this project out into a separate entity, perhaps, help maintain the company's role as a solely a uranium company. Meanwhile, I do think most eyes are on Anglach uranium project. It hosts about 43 million pounds of uranium at 0.7% U3O8. And that's amongst the highest grade we've seen outside of the Athabasca Basin in the world. There is significant resource expansion potential along the WAC 50 trend that they're working on. And they just raised 11 million bucks earlier this year, and they're going to be spending that on exploration here. The early stages, they're really impressing us. They've hit in the first 17 of 21 RC drill holes. Now we're still waiting for assays, but one thing about uranium is you can put out scintillometer results to let people know you are on radioactivity. It'll be at uranium or thorium, but in this case, it's mostly and most likely uranium. So we do expect a lot of news coming out this summer. Assays are pending. We expect a lot of news, met work, soil sampling, auger holes, RC drilling will be followed up by diamond drilling. So really stay tuned. I think that company, very experienced exploration management team, they know how to build resources very, very quickly. So with that, Donald, I think that's about all I have to say right now about uranium and lithium. So why don't I turn that back to you?
Okay, let me ask you, if you're new to the game or relatively new to the game, what sort of advice would you give in terms of how do you judge a mining project? What are the metrics you always look at? What are your favorite metrics that you go, oh, look at that one, look at that one, look at that one? Imagine you don't know much about it and you're not 40 years in the industry the way that you are. What would you be telling these folks?
Okay, well, first of all, every pound is not created equal. So, I absolutely hate using EV per pound. metrics, but sometimes that's all you've got. So, but sometimes you've just got to compare those to maybe smaller groupings. So if you were looking at your African groups, maybe EV per pound works, comparing one to the other. But really, you've got to also look at, sort of the corporate level, management experience, ESG and sustainability. Corporate strategy is important. Is the company looking to sell offtakes? Are they proposing a phase startup? Are they going to look at lower risk products such as spodumene concentrate, or are they going to go all the way with lithium carbonate and hydroxide? Which, if that's the case, what sort of risk is there trying to get that additional value out of the project? Is it really worth it? And then you've got your traditional, project metrics, jurisdiction, permitting, sustainability, project economics, CapEx requirements, and whether that can be funded by the company, production rate, revenue and cost forecasts, etc. And I think you do need to have a little bit of an understanding on getting to know some of the technical risks in the background behind some of those numbers. Metallurgy, recoveries, grades, impurities, and so on. And if it's something you just don't understand, you just have to do a little bit of work and ask somebody that does, perhaps.
So you don't think that if you don't know about it, you should just simply avoid? Your mantra is you should learn more.
You should learn more. You should learn more.
If the internet is there after all. That's what the internet is for.
Absolutely. And if you are trying to, mitigate risk, or even look to maximize the potential of discovery. When you're when you're dealing with a lot of juniors, and I'm talking sub 50 million market caps, I've always said, go out and buy a basket of these things. Don't necessarily buy one or two.
Right? Don't put your eggs all in the same basket. Is that what you're telling us?
Exactly. So
very good.
When you're looking at larger companies such as we saw today, fine, we can do that. But if you're looking at grassroots exploration, you don't know who's going to make that next discovery. Go out and buy 2 or 3 or 4 of them.
It's interesting that you talk about geopolitical risk, because Sigma are a terrific business, but they are the jurisdiction they work in with Bolsonaro and so on is a little bit volatile. So what are your thoughts on that?
Yeah, Brazil is a key mining jurisdiction. I also spoke to Valor Metals, and they've got one of their main projects is in Brazil as well. So I think Brazil as an emerging market is probably one of the least explored jurisdictions by Canadian or at least North American mining companies, which have tended to branch out throughout most of the world, but they haven't necessarily been as active in parts of Brazil. I think the upside is incredible there. Brazil does have an emerging EV sector as well. They're looking on making batteries. They're looking at using an awful lot of electric buses. So they need to source their own material as well. But they also know how to play on the world stage. They've been producing iron ore on bulk levels for years. So.
Now, Pete Higgins asks a very interesting question, but he's not been listening to my advice. My advice was keep it short. And this is anything, sadly, this is anything but short, but it is interesting. So let's persevere. So hang on and bear with us here. Pete Higgins, he's a lovely man. He does our Investing Matters podcast. And this is a long question from him. Last May, the beginning of June, Goldman Sachs UK-based analysts warned that the battery metals bull market was over for now. So Goldman Sachs in the UK is saying that the bull market is over for now, while Credit Suisse Australian team told clients lithium prices may peak in the next few months as market prices begin to balance supply and demand. This spooked the markets, and investors with lithium stocks got hit hard. Meanwhile, data this week is showing that Goldman Sachs was actually a net buy of lithium stocks. So he asks, what do you think about that? What are your thoughts on this?
Yeah, so as that certainly caused a little bit of volatility in the sector a couple of weeks ago, and I'd point to Benchmark Mineral Intelligence, and they had some good a good answer for that. You know, they sort of staged 5 reasons why they didn't think that this is the end of the bull market. And, you know, I certainly wish I remembered what those 5 things were, but, you know, certainly I think a lot of people can Google benchmark mineral intelligence 5 reasons.
But let's address Goldman Sachs. Where Goldman Sachs being naughty? I think that's Pete's question. Where were they playing the market for fools?
They, you know, I don't want to
both
speak ill of
ways,
them.
using their power in the market to influence, and then, oh, that I don't know.
I don't know either. So, you know, there certainly is, there are a lot of people out there that don't necessarily think $70 a ton is sustainable. And, you know, quite frankly, I don't think you need $70 a ton either when you can start producing, let's say on the high sides, $5,000–6,000 a ton, right? You certainly have incentive to go out and start up projects. Now, it's not that easy to start up projects. You know, you've got all your typical mining risks, but you've also got, like I said before, you've got to treat these as industrial minerals. And, you know, not all products are going to be suitable for either extraction. You know, Bolivia has a big headache with its magnesium right now. Okay, so that's why the world's largest resources sort of sits untouched. But also on the other side, if you've got too much iron, if you've got too much mica, if your sulfides are too high, your magnesium ratios are too high, you know, you might not be able to get it out of the ground very cheaply, but also people might not necessarily want to buy it if it doesn't have the right electrochemical properties.
Okay.
So years of testing go into these projects.
And the second part of Pete's question, he's quite a chap. Did this reduction of market cap value in any companies that you support, that you work with, Lakes, for example, or any of those other companies, did it impact their funding plans, given that the market cap was reduced and they weren't able to borrow quite so much?
I don't know if it's impacted anybody immediately. You know, I certainly think that the window is still open for people looking to invest in lithium stocks. You know, I can't speak of any companies that have come to market recently. However, a lot of companies that needed to raise money did. You know, Sigma raised money opportunistically already, and they are, you know, they're moving forward fully funded, and they're probably going to even be able to fund their second phase from cash flow from the first phase. But, you know, one thing you do see with these lithium companies is you see the Western governments getting involved, whether it's the UK Credit Export Agency or the or Canada. You know, Lake, for example, you know, this is a company that we do banking for. We have a buy on the stock, just full disclosure there. I think the target price is 315 Canadian. Sorry, 315 Aussie. So full disclosure, I don't own it. It's a banking client. But you know, they have 70% of their debt covered, even if they expand to 50,000 tons a year, like they plan to do with the upcoming feasibility study. And you know, you get I just said I don't know of any companies that financed recently. Well, guess what? You know, E3 just did. You know, they went to Imperial, and you know, if big oil is willing to put its money where its mouth is, then you know, I think that shows that insiders and people that know this industry is going to be around for a long, long time, and we're just at the early stages.
David Talbot, thank you so much for joining us this evening from Toronto. Well, it's afternoon for you, but it's evening for us. So, and that's it. Well, that's a wrap for our global mining special, which we did in conjunction with the wonderful folks at Red Cloud Securities. That's David, but that's also, and I have to specially thank Jeff Burdett and Rajni Saperko for their supreme efforts. We were all working over the weekend. I'm not sure we particularly wanted to be, but we were, just to get this event shipshape and sorted and ready for you as an audience tonight. So thank you very much to Red Cloud. They've been absolutely fabulous to work with. That's it from us after another great evening.